$7.9 billion vanished in February. Not from a hack, not from a collapse. From traders who bet Bitcoin would fall, and got it catastrophically wrong. What happened next tells you everything about where the price is heading. Those liquidated short positions didn't just disappear. They created a vacuum that's still pulling Bitcoin higher, and the mechanics of how that works are playing out in real time right now. Here's the chain reaction. When you short Bitcoin with leverage, you're borrowing the asset to sell it, betting you can buy it back cheaper. But if the price moves against you instead, your position gets automatically closed, liquidated, forcing you to buy at whatever the market price is. Now imagine not one trader, but billions of dollars worth of shorts all hitting that liquidation point within weeks of each other. Every single one of those forced by orders pushes the price higher, which triggers the next wave of liquidations, which pushes it higher still. That's exactly what crushed the bears in February. And the pressure hasn't let up. By early May, Bitcoin broke through $80,000 for the first time since January, driven by the same twin forces: institutional money flooding in through ETFs, and shorts getting squeezed out of existence. The funding rate, the fee shorts pay to hold their positions, stayed negative for 46 consecutive days. That means bears were literally paying for the privilege of betting against Bitcoin, bleeding capital every single day they held on. Open interest tells the rest of the story. It hit an all-time high of $47.5 billion earlier in the cycle, and recent surges of over $30 billion signal that new leveraged positions are piling in. When open interest climbs alongside price, it's not holders cashing out, it's new money entering with conviction. The market isn't cooling off. It's heating up. What makes this different from past rallies is who's buying. Spot Bitcoin ETF inflows topped $816 million in a single week in April. These aren't retail traders chasing a pump. These are institutions building positions with capital that doesn't panic sell at the first dip. While short sellers were paying fees and watching their positions evaporate, institutional buyers were absorbing every piece of supply the market offered. The math is brutal for anyone still short. Bitcoin is now trading above $81,000, and traders are openly targeting $90,000 as the next psychological ceiling. Some analysts are calling for $96,000, pointing to the momentum that happens when shorts capitulate all at once. There's roughly $200 million in short positions sitting near $75,000 that would get liquidated on any sustained move higher, another layer of fuel waiting to ignite. This isn't speculation about what might happen. It's already happening. The February massacre cleared out weak hands. The negative funding rates bled out the stubborn ones. What's left is a market structure heavily tilted toward upside breakouts, with institutional demand providing the base and leveraged shorts providing the rocket fuel every time they're forced to cover. The traders who shorted in February learned an expensive lesson. In a market with this much institutional momentum and this much leveraged exposure, betting against the trend doesn't just cost you the trade. It costs you everything. And the ones still holding short positions? They're about to learn it again.